If you're underwriting your commercial real estate deal expecting to refinance in year 3, you might be gambling, not investing. Let me explain. I'm not saying refinancing is bad. It can be a powerful tool. But when it's baked into the pro forma just to make the IRR pop, that's when it becomes dangerous. Here's what to look out for. 1. What is a refi-based underwrite? This is when a deal projects a big capital event, usually a refinance, at a future date. You'll often see something like year 1, 6% cash on cash, year 2, 7%, year 3, cash out. Refi, return of capital. IRR, 17%. But that IRR hinges on the refinance going exactly as planned. If interest rates are higher, if cap rates move, or if NOE doesn't grow fast enough, the refi doesn't pencil. Now your projected returns collapse. 2. Why sponsors do this? It makes the deal look better on paper. A return of capital from a refinance in year 3 spikes the IRR and shortens the payback period. But it's not guaranteed. It's an assumption based on future debt markets, which are unpredictable. 3. Bridge debt, the ticking clock. To make these pro formas work, many sponsors use bridge loans. Short-term was 1 to 3 year interest-only debt, floating rates, or variable terms. Optional extensions. If you meet certain tests, the idea is, we'll stabilize the property, increase NOE, and then refi into long-term fixed debt. But what happens if the market slows down? Rates go up. You miss your DSCR or LTV covenants. Now you can't refi, and you're facing a balloon payment. This happened to thousands of investors in 2023 and 2024. 4. You're betting on two markets. If you're investing in a deal that requires a refinance, you're not just betting on rent growth or tenant stability. You're betting on the future debt market. You're saying, I believe in 3 years, rates will be low, lending will be loose, and valuations will be strong. That's a big bet. Smart investors avoid deals where the business plan depends on a refinance. 5. The domino effect. If the refinance doesn't happen, the sponsor may be forced to sell in a down market. Capital may get wiped out. You could face dilution if the sponsor raises rescue capital. LPs get burned and learn the lesson the hard way. 6. What to ask. If you see a refinance baked into a deal, ask, what's the backup plan if we can't refi? Is there enough cash flow to support perm debt? What's the break-even DSCR at today's rates? Have you underwritten a no-refi scenario? 7. How to underwrite conservatively. Great underwriters build in optionality. They structure deals that can work even without a refi. They raise extra capital, lock fixed debt for longer terms, or reduce leverage. They don't stretch just to make the returns look better. Here's the bottom line. If a deal's success relies on a future refinance, you need to ask yourself, am I comfortable betting on interest rates and cap rates? What if I'm wrong? Can I still sleep at night? That's the difference between gambling and investing. If you want my conservative underwriting checklist, links below. And if you want more videos that save you from shiny pitch decks and painful mistakes, subscribe now.